Dear students, welcome to Swayam Shikshaa. We are here with the 10th theme, that is balance of payment. Uh, Trust me, students, BOP is a highly remunerative topic, and you can take this guarantee that after understanding this concept of BOP today, you can solve every question that comes up in UPSC. 99% of UPSC questions can be solved once this concept is clear. So please do watch this video till the end, and also let's solve few questions after understanding the concept. So let's move forward. First of all, let's try to understand what exactly is this balance of payment. So everybody says this is a very tough topic, but it is a very easy and a simple topic. We'll also pull some lines with respect to this topic, extensions to this topic, which can help you fetch definitely 2 questions in UPSC. Let's try to understand. So what is this balance of payment? Balance of payment is basically an accounting statement. It is an accounting statement which records details of economic transactions. It records details of economic transactions. What becomes important is it records economic transactions of whom is the important here. Important aspect is it records economic transactions of the residents of the country. Residents of the country. Residents of the country with rest of the world. With rest of the world. This is what is very important. Residents of the country with rest of the world in one financial year. When I say one financial year, that is basically from April 1st to March 31st. Okay. Now, when I use the word economic transactions, then what are these economic transactions? So, economic transactions will include transaction of goods, that is export and import of goods. Okay. It also includes unilateral transfers, one-sided transfers. It also includes, very important, it also includes income. So we know that something like net factor income. So income can be in the form of rent, income can be in the form of dividends. So all this is income. So it records income. It also records something like the services inflow and outflow, and it also records movement of capital, or it is basically with respect to assets, or we call it as investments, etc. Call it as capital. So when I talk about goods, this is the visible item, something which I can feel and touch. Very important. What is visible? Something that I can feel and touch. But when I say unilateral transfers or income or services, these are basically invisibles. Invisible. So when I say economic transactions, these are the economic transactions. These are the economic transactions. Now the question comes up. When we say this BOP is an accounting statement, it is basically a double entry system. Double entry. So when I say double entry system, it records 2 types of transactions. One is the debit transactions, and another one is the credit. So when I say double entry, so any of the transactions either should get into the debit or it should get into the credit part. So simple logic to understand. When I say debit, that means money is moving out of the account. When I say credit, money is moving into the account. Simple. When I say credit, what will come in the credit? Export of goods. When I'm exporting goods to other countries, I receive money, dollars. So export comes into the credit part. Similarly, unilateral transfers from abroad. Unilateral. Very important. Unilateral. One-sided. In return, there is no good, etc. Unilateral transfers from abroad. Money is moving into the BOP account. So therefore, we call it as unilateral transfers from abroad. Money is moving in. export of services. Export of services. Okay. And here, one more important observation. So, export of goods, unilateral transfers or services, or income, income from abroad, income of residents from abroad. Okay, or you can say net factor income from abroad. So money is moving in. All this will be part of the credit. Then obviously what will come in the debit? So debit should have something like import of goods, the visible aspect. So here, this is the visible aspect. This is the visible. This visible aspect, we also call it as the balance of trade. Visible aspect, we also call it as balance of trade. So when I use the word balance of trade, it talks about the difference between the exports and imports. And India's case, we find that the import is more than export, import is more than export, or we have something called as the trade deficit. Trade deficit, very important understanding. Then what else will come here? Unilateral transfers, unilateral transfer to abroad, unilateral transfer to abroad. Then comes up services, services import, import of services. Import, money is moving, so you're importing and you're paying, money is moving out. And then income, net factor income to abroad, to abroad, net factor income to abroad. So trade wise we are negative, but services wise we are generally positive. Services wise we are generally positive. Okay. Unilateral transfers, which includes remittances, gifts, all that. So this unilateral transfers we are generally positive because remittances, India ranks number one. Okay. Income, when it comes to income, we are slightly negative, slightly negative. Now, let's try to understand it this way. Now, this portion, what we have discussed now, this portion, which includes the visible, that is the trade part, and the invisible part, put together, we call it as the current account. We term it as the current account. Okay. Now, after the current is over, after the current account is over, we have one more account which we term it as the capital. Capital. So, this capital account has again the credit part as well as the debit part. Okay. So, here one more important understanding is in the credit inflow. So, here it will be something like investments, investments from abroad, from abroad, money is moving in, so investments from abroad, investment is coming into the account, investment from abroad. So obviously in the debit side we will have something like investments to abroad, to abroad. Okay, similarly borrowings from abroad, borrowings from abroad. Very important understanding. Borrowings from abroad should be in the credit. Money is moving into the account. Now here comes up borrowings. Borrowings to abroad. Borrowings to abroad. So this portion basically is the capital account. Capital account. Simple logic here. In the current part, if there is a deficit, for example, the debit part is, let's say, minus 1000. Debit part I've written minus 1000. Credit part I've written plus 500. 500. So the net current account deficit, net is how much? Net would be minus 500. Net is this one, minus 500. So there is a deficit. This minus 500 or the deficit, we call it as the current account deficit. Very important understanding. This deficit of minus, we call it as the current. Now we use this investments or the borrowings to bridge the current account deficit. So if there is more investment into India, that will also help us with respect to the current account, because this is an accounting statement. So when there is surplus in my capital account, let's say if I have $500 in my capital account, from this $500, I push it into the current account, I bridge the balance, and I make this accounting statement zero. BOP will become zero because I'm putting from my capital account into the current account, and ultimately I'm making this BOP statement zero. So investments moving into India will also help. That is something that is coming into the capital account will also help in handling the current account deficit. This is what is a major understanding, because UPSC asks some simple questions. Which one of the following will help in bridging the current account deficit? Then something which is moving, that is investments, that is part of the capital account, which is coming in here, we can observe here, which is moving in, will also help the current account. This is one more important understanding. Now, another important aspect, very important aspect. For example, even in the capital account, we have, let's say, deficit. For example, current account is minus 500 and capital account. So capital account, instead of having plus 500, we have something like only 400. So there is minus 100 now. We need something like minus 100. In this case, we need something like minus 100. So this minus 100, let's try to understand this minus 100 which is there. How do I get this minus 100 now? So what is the option? Now capital account is also over. In capital account there is deficit. Then we have the RBI reserve. Very important. Now from this RBI reserve, RBI is a custodian of Forex. So RBI has Forex reserve. And from this Forex reserve, we will try to pull out money. Okay, so we will try to pull out money. So if you try to observe here, in this case, we can pull out money. Okay, and we will try to bridge it. So here, from the Forex reserve, so Forex reserve inflow, okay, or Forex reserve outflow. Now, if I am taking the reserve from RBI, and that means I have to take how much now? I have to take 100. And bridge. And now again the BOP account will be zero, BOP account. So outflow into Forex reserve is one aspect. Inflow that is moving into BOP account. So now here something like the inflow is something like if there are Forex reserves removed from RBI, that means plus $100 I'm removing from RBI. Okay, so that is, there is depletion of foreign currency assets. Now depletion of foreign currency assets. So here depletion of foreign currency asset, why is this depleting? Now this should come under the credit. Why it should come under the credit now? When we are depleting the foreign currency assets, depletion. So here I'm taking $100 and pushing it into the account. That is, it is moving into the BOP account. So it will be part of the credit. But at the same time, it is leading to depletion of foreign currency assets. So depletion of foreign currency, depletion of foreign currency assets. Okay, depletion of foreign currency assets, because assets are decreasing here. Why? We are pulling it out from the RBI's account. Okay, but it is moving into the economy, it is moving into the BOP. So therefore it will be depletion of foreign currency asset will be part of the credit, because money is moving into the account, but there is depletion from the RBI's basket or the Forex. But now, for suppose if there is a positive aspect, that is BOP net is $100 positive, this $100 now will get into Forex, will get into the reserve. That is addition or increase of foreign currency asset. This is increase or addition to the foreign currency asset, increase of foreign currency asset. Now, but this will be part of the debit. Why? Because money is moving out of the BOP account. So this is addition to the foreign currency asset. So this is basically kind of an outflow. So outflow, therefore it will be part of the debit. So outflow into the RBI reserve. So this plus 100 which is there will go into the RBI account, and ultimately it will become zero, this plus $100. So this is outflow of foreign currency or addition to foreign currency asset will be part of debit, and depletion of foreign currency asset will be part of credit. So like that we'll use our RBI reserve also to handle the BOP account. Now this is the first and the most important understanding. Once we have understood this, rest of the things are very, very simple and very easy. Now, if I have to further segregate BOP, what we have done is we have divided it into the current, okay, in this above discussion, and we have also divided it into capital. Okay, in the current part, we have written trade, unilateral transfers, income, and we have also pushed something like the services. Okay, and in the capital part, two things here. One is investments, and second one is the borrowings. Very important learnings for UPSC. Very important. There will be questions from this area. So when I say investments, now I will put FDIs will move into India. It can be foreign institutional investments, etc. Okay. Now FDI and FI, or I will use the word portfolio, the wider perspective, portfolio. Now one more important understanding is, according to the new definition of FDI, in a listed company, very important, in a listed company, if my investment is going to be more than 10%, in a listed company, something that is listed in the stock market, if my investment is going to be more than equal to 10%, it will be treated as FDI. Okay, so even the portfolio investment, if it is going to be more than equal to 10, henceforth it will be treated as FDI. And one more important thing, if it is once an FDI, it is always an FDI. That means the next year, if the investment is going to be less than 10% also, it will be treated as FDI only. This is one more important understanding, very important understanding here. Okay, so there was a question asked related to this. Now, when it comes to borrowings, one is ECB, external commercial borrowing. Okay, and then we also have external assistance, which is also called as the soft loan. So ECBs are basically commercial loans for a long-term period. And out of the total external debt, very important point, out of the total external debt, maximum amount of external debt is the ECB, external commercial borrowing, followed by the NRI deposits. So NRI deposit will come later. NRI deposit followed by the NRI deposits. So NRI deposits again can be in the form of FCNR. Okay, non-resident ordinary, non-resident external. There are different types. FCNR is basically only a term deposit which is maintained only in dollars. So NRI deposits are also seen as debt only. And in this also we have three categories. One is we have the FCNR, foreign currency non-resident, and then we have the NRO, and we also have the NRE, non-resident external. So this FCNR is only in term deposits. Others can be in term deposits or it can be in demand deposits. NRI can put the money. Okay. Now FCNR is only in term deposits maintained in foreign currency. That means money is coming for 1 year, 1 to 5 years, etc. Maximum external debt is in the form of ECB followed by NRI deposits. Now, one more important understanding, foreign currency convertible bonds. UPSC asked this question, anything related to convertible, something that bond that can be converted into equity at a later date. So these foreign currency convertible bonds, if you understand, some portion of these bonds can be converted into equity. Only that portion which can be converted into equity will be treated as FDI. Otherwise, that FCCB should be part of the debt part or the borrowings part. But only that portion of FCCB, foreign currency convertible bond, which can be converted into share or equity will be treated as FDI in India. Now, one more important learning here. In an unlisted company, listed is something that is listed in a stock exchange. Something that is an unlisted, any investment into unlisted company will be treated as FDI. Not as the portfolio investment. Any investment into unlisted company will be treated as FDI. Now, once this concept is clear, now we will solve some questions. Previous questions, we'll try to understand that these previous questions are very simple and easy. Very simple. See here. In terms of economy, the visit by foreign nationals to witness a Commonwealth game. So if a foreign national is coming in, Okay, and he is spending some dollars. Okay, so it will be treated as export because he's spending some dollars in this case. Since he's spending some dollars, it will be treated as export. Okay, now see this. Next question. Consider the following actions which the government can take. Okay, which of the following actions can help reducing the current account? Once you have understood the concept, only then you can answer this such questions here. Devaluing the currency may make our exports cheaper and exports competitive. So if there are more exports because of that, there is every chance that yes, there's every chance that it can improve our trade. But at the same time, there can be doubts that devaluation can make our imports costly as well. But devaluation can make exports competitive. Then reduction in export subsidy. This is wrong because exports are going to come down if you reduce export subsidy. Adopting suitable policies which attract greater FDI and more funds from FI. Yes, something in the capital account will also help in bridging the current account. This is the understanding. Now, one more learning here. There is a concept called as J curve. J curve says whenever a rupee value is depreciated or devalued, then that there will be first something called as the trade deficit. There will be trade deficit. So suppose this is the 0 point. Okay, so when I am reducing the value of currency or the currency is getting devalued, if this is the trade account, trade, this is the 0 point. First, there will be trade deficit. Deficit increases and then over a period of time, the graph moves above. That means first there will be deficit and then trade will become surplus. This is called as J curve. Very important. Next is BOP is a systematic record of. Now, such questions, we have to look for the most comprehensive answer. So, comprehensive here, goods exported, it is partial. Economic transactions, governments, not just government, it is all the residents, not just government, people like us as well. Capital movement from one country to another, this is wrong. So, all import and export transactions in a given period of time normally are. So, this is what we have to understand. This is a comprehensive entity. Then, next here. Which of the following will constitute capital account? No, remittances or unilateral transfers will be part of current. We have seen that, we have discussed. Okay. Investment, yes. Loans, yes. FDI, yes. All investments and borrowing. So obviously 1, 2 and 4 should be the answer. Once the concept is clear, there is no way you can make a mistake in economics. With reference to BOP, which of the following constitutes the current account? Now, reverse type of question. Now, current account, trade, the visible part, assets is something part of the capital. Okay. Invisibles, yes. That is about the unilateral transfers, services, income, etc. And special drawing rights, no. So, answer should be 1 and 3. Concept is clear. Then it is simple. Next is which of the following best describes import cover? Improvement of import cover is good. That means it talks about the number of months of import that could be paid from the total reserves we have. It is very important. If you don't have proper import, you cannot cover your imports, then we may get into crisis. So here it is the number of months of import that could be paid for. Okay, by the country's international reserve. You have so much of reserve that you can cover your imports. How many times can you cover? Okay, so that is what is import cover. Now, see here. External debt, most of the India's external debt is owned by government. No, it is ECB. So that statement is wrong. All of India's external debt is denominated. No, around 54 to 55%. All our external debt. These are extreme statements. How can they be right? Now, all our external debt is denominated in US dollar. That can't be the case because there will be at least some portion which is not in dollars. Okay. And as I mentioned, external debt, you have first is ECB followed by NRI deposits. Okay. If there is a financial crisis in the near future, which of the following policies are most likely to give some immunity? Not depending on short term foreign borrowings, opening up to more foreign banks, maintaining full capital. Risky things have to be avoided. So, if there is some crisis like BOP, okay, so you cannot take too much of risk. Maintaining full account, capital account convertibility can add on to risk. Okay, so opening up to more foreign banks could add on to risk. So something that is risky should be avoided. So here in the options, whatever is risky has to be removed. And therefore you have, this is one such option where the risk is less. Okay. So now last question. With reference to the international trade of India at present, which of the following statements are correct? Now, through logic, we can answer this question. Merchandise export means trade, basically goods only. Exports are less than its merchandise imports. India's import of irons, chemicals, fertilizers have decreased in the recent years. This is the data which we may or may not know. India's export of services are more than its imports. This is true. India is generally positive with respect to services. Exports is more than its imports. So three should be there. India suffers from an overall trade or current account deficit. India suffers with overall trade or current account deficit. So India generally has current account deficit. Okay, so and then India's merchandise exports are less. So answer should be one is okay. Okay. And three is okay. India's export of services are more than its imports. And so generally we face trade or current account deficit. So 1, 3, and 4 seem to be okay. So like this, based on the logic, we can answer, and most importantly, concept becomes more important. So I hope I've added value. And once you watch this video, I hope your BOP concept will be completely clear. Keep subscribing. Do comment in the comment box so that it will act like a booster and so that we can contribute and help you out with respect to your prelims. And please do share our videos. Signing off. Thank you. All the best.